Hey guys, welcome back to another video. I'm Dave, and today we have to talk about a long overdue topic, which is what the heck is going on over at Redwire Space. This is one of my other space stocks. Yes, I am not only invested in Rocket Lab, even though Rocket Lab is, of course, my favorite space stock. I have made investments in Redwire as well as Planet, Intuitive Machines, and some others over the years, getting in and out of those ones. And Redwire, let's just say it has not been pretty over the last year. So what the heck's going on there? Is it super cheap now and a screaming buy? Is it a sell? Let's dive into all that today. Before we do that, though, if you're new here, please do consider hitting that subscribe button. It is so helpful to the continued growth of this channel, and thank you to all my current subscribers and channel members for your support. Okay, with that out of the way, let's dive into Redwire's crazy year. So, starting off with the stock chart, it is certainly not pretty. They were riding high going into the 2025 and above $20 per share, 25 plus if I recall correctly. Things were looking great, and we have absolutely crashed, kind of bounced back once and crashed once again. We have seen a lot of growth and speculative stocks kind of crash lately, but not really to the degree that Redwire has. There's clearly something more going on here than the overall markets. We're going to kind of summarize that and talk about my thoughts on the company. So if you are familiar with some of these events, I apologize for a bit of review, but we'll get into my current thoughts and what I'm planning to do in just a little bit. First of all, I always like to disclose my buys and sells when I am talking about a company on the channel. So here you have it. I did buy 300 shares of Redwire back in 2024. And did sell some actually near the peak. Really lucky timing on this one, or perhaps good. Sold half my position up at about $24, and then bought a bit on the way down several times, 250 shares, 100 shares, 300 shares, another 100 shares. Then fairly recently, in I think it was September, I was really excited about the potential for Rocket Lab, and I wanted to do a short-term trade around that. I didn't have a ton of cash, so I did sell 400 shares, put them into short-term Rocket Lab call options. That worked beautifully. I got a double on those shares, so that worked out really well. That was more about Rocket Lab and my excitement around them than Redwire, if I'm being honest. But yeah, it was a combination slightly of me being unexcited with Redwire. So the total money put into the stock was about $11,300. The total money pulled out of the stock was about $7,300. Means I am in for about $4,000, and the current value is only $2,760, which means I'm down by about $1,250. Not the end of the world, of course, and I'll take the tax write-off on some of those shares that were sold here for a loss. I think I was underwater there. I'd have to calculate the average. But I know there's a lot of people out there hurting worse than me, who certainly bought a lot more Redwire shares than I did. Doesn't make me happy about it by any stretch, and we're going to talk about where to go from here. Yeah, just a quick screenshot of some of those buys and sells, just to be completely transparent, but let's move on. So I think if you follow Redwire at all, you will be familiar with their big announcement that they were purchasing Edge Autonomy, an autonomous drone company. And this was very interesting for a lot of the reasons. First of all, Redwire, a space company, purchasing a drone company, did seem a little odd, first of all. The company did kind of explain that. We'll go into this in a little bit. But yeah, the announcement was January 20th, 2025. And highlight, they expect it to be immediately accretive to revenue, adjusted EBITDA, and free cash flow. So basically saying Edge is already free cash flow positive, adjusted EBITDA positive, and will pull upward those metrics for Rocket Lab as opposed to making them less profitable in the short term. So keep that in mind. Now, reasons why this transaction or purchase could make sense. I do think that drones have been shown to be incredibly important when it comes to national security and defense lately, especially with what's going on in Ukraine and other places. We can just see they have become incredibly essential. I think it's going to be a fast-growing industry, and the demand for these drones is only going to increase. And yes, they can work together with satellites, which is a system you might call joint all-domain command and control. So some high-up satellites spot something fishy, they autonomously tell drones to check it out in person. The drones can then show the footage to your troops or whatever on the ground, and it can all work together beautifully, which kind of makes sense, I guess. And I did kind of buy this explanation. I was like, okay, I guess it kind of fits. And you can see in the picture here from their investor presentation, they got the satellites, then the drones communicating with the satellites, the drones communicating with the people on the ground as well. So I kind of bought it, but I'm still having some second thoughts about it right now. But let's talk a little bit about the reasons why people were concerned with this transaction, because it was not universally acclaimed by any stretch. First of all, I always find it really just a little odd when a company is buying a company that is practically the same size as it. I mean, I guess, these things do happen, but to me, it's always just been a little bit odd. So Redwire, when they kind of announced this, were earning about just under 300 million. Edge was earning 222, so like a very large company for someone like a Redwire to digest, in my opinion, and kind of integrate. Now, the thing that's interesting though is Edge was actually much more profitable than Redwire when they were making this acquisition. We've seen this a lot lately, kind of less profitable companies acquiring more profitable companies, which sounds a little backwards, right? Like if you're making money, someone else is not making money, shouldn't it be you acquiring them? But we've seen this with Intuitive Machines and Lanteris lately. We've seen this with Redwire and Edge and several others where companies are able to basically raise capital, get a good valuation on the public markets, and then acquire companies that are even more profitable than they are. So always feels a little odd, but that is what it is. And then the backlog, of course, okay, Redwire does have significantly more backlog at that point than Edge. And yeah, but it was just a little bit of an odd transaction to me, just the size of it. If you look at it in market cap terms, Redwire agreed to purchase Edge for $925 million, and this closed on June of 2025. Now, Redwire's market cap in just April, just a few months before the deal closes, $820 million. So you have a smaller company acquiring a bigger company basically at that point. Now, I do think Redwire's market cap did kind of rise to the point where it was above Edge by the time the deal closed, if I recall correctly, but still an odd one. Like anytime a smaller company at least appears to be buying a bigger company, it's a little bit of a head scratcher. But the crazy thing today is we're talking about a combined company after the acquisition being valued at $900 million. So what the hell happened? You have a $900-ish million company buying, say, another $900-ish million company, and the combined value is now $900 million. Something doesn't add up there, So yeah, what's going on here? Let's continue looking into it a little bit further. And now just a quick break to tell you about the sponsor of today's video, Brilliant.org. Brilliant is the interactive learning app that helps you become a better thinker and problem solver. Brilliant has thousands of visual, hands-on lessons across math, science, programming, data, and AI. Of course, a lot of this can be applicable to your own investing journey as well. What I love about Brilliant is how practical it feels. For example, their Exploring Data Visually course teaches you how to see trends in complex data sets, skills you can apply directly when analyzing the markets. And their Regression and Classification course helps you to understand the models behind forecasting, which is huge if you're trying to make sense of financial data. Brilliant makes it easy to build a daily learning habit. Just a few minutes a day sharpens your problem-solving skills, which pays off whether you're studying math or evaluating an investment opportunity. So if you're interested in continuing your learning journey on Brilliant.org, head over to Brilliant.org/DaveG. Scan the QR code on the screen or click the link in the description. Brilliant is generously offering our viewers 20% off an annual premium subscription, which is unlimited access to everything they offer. And thank you once again to Brilliant for sponsoring this video. Now, back to Redwire. So if you recall, Redwire did go public through a SPAC merger, and they were formed by a PE company called AE Industrial Partners, a private equity firm back in 2020, which was by combining two of AE's other companies. Now, what is AE? What is a private equity firm? I think it's kind of important. A PE firm is an investment management company that raises capital to buy and take control of private companies or take public companies private. They then aim to improve the company's operations and profitability and later sell it off for a profit using a variety of strategies, such as leveraging debt for acquisitions or providing growth. Well, I don't know why this is clicking. I'm not even touching anything there. That is very weird. Sorry about that. Okay, we have erased that. So how they operate, yeah, they raise capital from investors like pension funds, high net worth individuals. They then invest in some cases, buy companies, and then they manage those companies and improve them, and then they will want to exit because they need to provide a return on investment to these investors. So they're looking to distribute profits back to investors eventually. Nothing wrong with that, right? I mean, if you think you can add value, make a company run better, buy it, and then resell it, more power to you. I'm not saying there's anything wrong with PE firms, but something I do think I really need to point out is that AE is an extremely large presence and large shareholder in Redwire still to this day. I believe it's over 50% now. I think it's actually gone up recently. And if you wonder just how much of an influence might they have in the running of this company, well, you can take a quick glance at the Redwire board of directors. Going through it quickly, we have Reggie Brothers, who has served as operating partner of AE Industrial since 2022. Mike Green, co-CEO and managing partner at AE Industrial. Then you have Kirk Connor, served with AE Industrial Partners as a partner since 2019 and as a principal starting in August 2014. So 3 of the current 9 members of the board are AE Industrial employees or members. As I said, AE, big owner of Redwire, but not the sole owner, of course, because it's publicly traded, and there's a lot of shareholders out there like me who did put their money into it. Now, why do we care? Why does this matter at all? Well, normally it wouldn't really matter, right? AE is just doing their thing, trying to create value, reorganize the company to perform better. That's all good if I'm an investor. But you can see AE also owned Edge Autonomy. So now you have Redwire, which is majority owned by AE but not completely owned, buying another AE-owned company. That's kind of a conflict. How can me, a Redwire shareholder, and you guys out there, presumably some Redwire shareholders, be confident that Redwire's management is going to negotiate the best deal possible to purchase AE when Redwire's management also owns that AE asset? So a little bit of a conflict there, in my opinion. Also interesting to note, AE, a very big player, investor in Sierra Space, another company you guys are probably familiar with. Firefly Aerospace, another company they just recently took public. York Space Systems, they just announced an IPO of this one as well. So a very big player in the space industry right now, going public with some interesting names and stuff like that. But when you have the management of one company buying another company they own, that's all good, in my opinion, until you have shareholders in there as well. Then things get messy. So it could have all been above board. It could have been a great deal for Redwire shareholders. But I just don't like the appearance of it. And I think there is a conflict. Like, I don't know how you can say there's no conflict whatsoever there. Yeah, even if, we got a good deal on Edge. Yeah, it just bothers me a little bit. I have to admit that. So continuing on, we'll kind of circle back and talk about this edge thing, but that was a big part of the earnings for the year. That big deal closed this year. A massive company changing deal changes Redwire from just a space company to now a space and drones company. Q1 earnings. Let's talk about it. Revenues decreased by 30% year over year to $61 million compared to $87 in Q1 of 2024. Obviously, you don't love to see that. During Q1, the company had a net unfavorable EAC change of $3.1 million. An EAC change, basically estimate at completion. So the company is estimating how much a project will have cost them at completion, and therefore, how much money they'll make off of it. And they're kind of realizing, oh, this project we got is going to cost us more than we thought to complete, so we have to change this by $3.1 million, and you're going to see some more of these coming soon. Net cash used in operating activities increased by 48 million bucks. Not great. So negative 45 million versus positive 2.8 million the previous year. This included one-time payments of $8 million related to litigation settlements. I don't actually know what that litigation was about. There's a lot of frivolous lawsuits out there, but there's a lot of serious stuff too as well. And yeah, that's something I'd love to dig into further. Let me know down below if you guys looked into what this litigation was, because I'd love to hear about it. And then some money related to M&A activities, because they're always active with their mergers and acquisitions. So from their sheet here, 2025 outlook, they did kind of forecast some pretty good growth rate, but I don't like how they talk about it. So this Edge Autonomy acquisition had been announced, was not closed yet. And then Redwire says, as if the transaction had closed at the start of the year, which it hadn't, it closed in June. But if it had closed at the end of the year, the combined revenue of the company would be this, 535 to 605. And this just kind of confuses me, right? Because then it's like, okay, well, if it closed, but it didn't close, so what's the real revenue of the company for the year, I guess they feel like that gives you a more fulsome view of the revenue run rate of the company post-Edge purchase, but it's just a little bit weird to me. And it does show that they are looking at revenue compound annual growth rate over a couple years being 53-ish%, which is actually amazing, by the way. Very happy with a 53% CAGR, if you will. And adjusted EBITDA of the combined company going significantly more positive after a negative 2024, all the way up to like over $100 million in adjusted EBITDA, or at the high end anyway, which is great, and I was pretty excited about at the time. So that's kind of how they were talking about it. Now we go to Q2 earnings. What happened then? Well, Pete Canito went on Fox News to kind of talk, this is day before the earnings call, about their new Space MD operation to commercialize, pharmaceutical development in space. And, I do think the pharmaceutical crystals are pretty cool, and it's fine to go on TV and talk about those before earnings. I guess some people didn't like it. But for me, the issue becomes, like, you knew at this point the earnings were going to be bad, and this is Q2 earnings. They were very bad. We're about to get into that. I'd much prefer the CEO to go on after the earnings and kind of explain what's going on, as opposed to doing these TV spots before earnings and kind of hyping up one of their new ventures. But so that was a criticism. I don't know how fair it is. I guess the Space MD announcement happened when it happened. I did talk to Pete in actually an hour-long interview, and he does seem like a good guy. So I'll try to link that video down below. But I have some questions about how the company has been run and what's going on here as we'll continue. So in those Q2 earnings, revenues decreased 21%. Year over year to $68 million compared to second quarter of the previous year. Net loss increased by $78.9 million to negative $97 million compared to just $18 million in the negative for Q2 of 2024. So massive loss there for the quarter. Adjusted EBITDA decreased as well by $29 million to go negative $27.4 million compared to positive $1.6 million in the second quarter of 2024. And by the way, this positive number here is actually what really excited me about the initial Redwire investment. One thing I love to do is buy a unprofitable company investing for the future right before they become profitable. I just find that's generally a big catalyst for stock price appreciation. And if you can buy a company right before it goes profitable, you can tend to do very well. And that was a lot of my thesis and excitement around Redwire, that this thing was about to go profitable. And it actually, by adjusted EBITDA, not like actual EBITDA, but adjusted, which is still something, they were going profitable, and that was a great sign. So yeah, that one very much in the wrong direction. And then the net cash used by operating activities increased by $78.2 million to negative 87 compared to just negative 9 in that 2024 year-over-year comparison. So when I saw this, yeah, it seemed like horrendous quarter, brutal numbers downward for everything. Was not very excited, was taken aback. The acquisition closed in the final month of the quarter. I think there was maybe like 2 or 3 weeks of the two entities operating as a combined company in Q2. So if anything, you would think, okay, there's going to be a nice bump to revenue in that last couple weeks, and it'll increase a bit because of the contributions coming in from that Edge deal, which was so massive to Redwire. Continuing on the earnings, they actually reduced their forecast, which was even worse. So for the 12 months ended December 31st, 2025, Redwire, including Edge Autonomy from the date of close, is forecasting full year revenues of $385 to $445. Now, if you look at the previous language they used, which is as if they had been combined since the start of the year, the forecast is also lowered 470 to 530. This is reduced from the previous Q1 guidance, 572 at the midpoint. So the midpoint of this 470 to 530 is 500, midpoint previously 572. That means a $72 million decrease in guidance. That's extremely substantial when you're talking about a company making $500 million-ish. So yeah, extremely substantial decrease in guidance, and was a little shocked by that, not too happy. Now, I know they said they experienced more EAC impacts due to non-recurring engineering issues on a few emerging tech programs, and they had to, add these EAC costs. And then, of course, they had that purchase of Edge Autonomy. So that was Q2. Right here is when it happened, pretty clearly dropping off a cliff from about, I call it $14 to what, about $8 maybe-ish, maybe $8, yeah, let's say at that point. So pretty catastrophic quarter, but maybe it was a one-off quarter and things were just got all the bad news out of the way and it would be only up from there. Well, maybe not, because then we go to Q3 earnings, which is on November 5th, just recently. Q3 highlights is that revenues did increase 50% from the Q3 of 2024, which is nice to see. That's 50% is a great growth rate if they could sustain that. However, net loss for the third quarter of 2025 increased by $20 million to negative $41.2 million. This confused me because, you're bringing on Edge, a company that's supposed to improve the bottom line, be already, in a much better place, and yet we're really dropping in the net losses. Adjusted EBITDA decreased by $5 million. Same thing here. Edge is supposed to be adjusted EBITDA positive, so if you're bringing this company on that's practically the exact same size as Redwire, it's adjusted EBITDA positive. How is our adjusted EBITDA of the combined company getting worse? In Q3, of course, by this point, Edge is combined with Redwire for the entire quarter. So that was a shock to me as well. During the quarter, the company had yet another unfavorable EAC change of $8.3 million, impacting revenues. So then I'm just thinking, well, what? Can they not accurately estimate how much these projects are going to cost them? They're just underbidding from what they will actually end up having to spend on some of these contracts. Is that what's going on here? That might have something to do with it. Starts to not look great in terms of execution. Now, the book-to-bill ratio was 1.25, which is nice. Anytime it's above 1 is a good sign. That means they are booking 1.25 times the contracts that they're billing. So a good sign of future growth, at least on the top line. Net cash and operating activities came down, so obviously didn't come down year over year, but quarter over quarter it did, to negative $20 million. So I was a little bit confused again by this earnings, thinking things would be better with Edge in there. The company is supposed to be so helpful to the bottom line of Redwire. I mean, if we just go back to this slide here, you can see the combined adjusted EBITDA from, say, Redwire in 2024, slightly negative, should go well positive for 2025, according to what they had been saying. Now, not only were those numbers not as good as I was expecting, they did decrease their forecast for the year yet again. And at this point, I'm just kind of like, what the heck's going on here, guys? Do we not know, how much we're going to make for the year? Like, honestly, like I was, getting quite confused. So what they said is due to the ongoing U.S. government shutdown, a number of our anticipated orders have been pushed out of the quarter and into 2026. As a result, the 12 months ended December 31st, 2025, Redwire, including Edge Autonomy from the date of the close, is forecasting full-year revenues of $320 to $340. So in Q2, the guidance at the midpoint was for $415 million on the year, and now that's adjusted down to $330 million at the midpoint. So extremely significant, needless to say. So yeah, you get a lot of people thinking, like, was something going wrong with Edge? Did AE Industrial know that Edge was going to have a bad time and they wanted to unload it, so they just combined it with this other company they control, Redwire? Is that what happened here? There's a lot of those theories going around. I don't know for sure, but I do know that when you're buying a company you own and you're publicly traded, you open yourself up to those uncomfortable questions. Now, the explanation that it's because of the government shutdown makes me scratch my head a little bit, right? Because the shutdown from October 1st to November 12th. Is it possible that the government is buying that much stuff? And not only that, they're going to order it and pay for it within the same quarter? Like, usually a lot of these programs have a lead time to them. You sign a contract with the government and it takes quite a while to, manufacture your product, your satellites, your solar panels, whatever it is, and deliver them. So usually there's more of a lead time than this, but they're saying between October 1st and November 12th, they were, I guess, expecting to sign government contracts valuing the difference between 415 to 330. So what are we talking there? Like $75 million or maybe $85 million just in that month and a half, and all that's getting pushed to next year. I don't know. To me, this explanation is a little bit shaky. Maybe it is true, but generally I find the lead time on some of these contracts is longer than that. And the government shutdown, I mean, yes, it's impactful, but it's over now. And you'd think they would kind of place the orders they were originally going to place. I don't know. This explanation, odd to me. And again, it makes you wonder, is Edge not performing as well as expected? Like what? I don't know. It's just a bit of a messy situation right now. Q3 earnings happen. Stock price is $7.25 maybe at that point. Then it drops down below $6, continues to drop from there. And then something else does happen as well. Redwire announces a offering of stock to raise capital. Aggregate offering price up to $250 million. So if you have a market cap at this point of $900 million and you're raising $250 million, now they do say this is at $6.95 per share, and it's gone down since then. But to me, that's still like 25% of the company being diluted. So let's say Dave sitting over here owns, 10% of Redwire. After the dilution, I guess I only own like 7.5% of Redwire. Something like that. So a big dilution factor if and when they do issue these shares. And it just seems like a really bad time for it. I mean, this is a 3-month chart. Like, let's zoom out. Like, this is where we're issuing shares. Like, you could raise the same amount of money up here, and the dilution would obviously have been much less, even like up here. It's just a bad time for it. So maybe they wait a while, but a little frustrating on that one as well. So yeah, things just don't seem to be going great, and there's some head scratchers there. So if you look at the dilution, this is a post by Scott O, great guy, also talks about Redwire, a friend of mine, so I don't think he'll mind me kind of quoting his chart instead of reinventing the wheel and remaking it. But here's his account here if you want to check him out. This just is the kind of dilution we're seeing with the acquisition of Edge Autonomy, and once those initial those shares are also sold out there, going from like sub 75 million shares outstanding to 250 million plus. That's a lot of dilution, so just something to keep in mind as shareholders. And as I said previously, the thing that makes me the most sad, my whole thesis was around 2024. I'm like, this baby's going positive, man. We're getting in the right direction. We're going positive. We're going to have a pop when that happens. And it's just unfortunately gone down. So I know there's kind of one-time stuff here in the EAC charges and stuff, but just disappointing for me because that was my whole thesis, was the profitability point on the company. Now, a lot of shareholders out there getting extremely frustrated. If you just check Reddit, of course, you got stuff like petition to change the company name to Red Candle, talking about how company executives used to say that we want to overpromise and over-deliver, but the over-deliver piece hasn't been happening. And then someone saying, oh yeah, the space project is over, we're basically just a drone company now, what's going on? A lot of people upset. It's understandable if you've lost a ton of money on the company. Have been some positive news over these months. I don't want to make it seem like nothing good has happened. That they have announced some interesting contracts and things like that. And then you do have some insider buying going on right now, which is generally considered to be a bullish thing. CEO Peter Canito buying here. Some other insiders buying recently. A lot of buys recently on the insider. So I guess insiders do think it's undervalued at this point. Which brings me to the question, okay, things have gone bad and I'm not happy with how things have been run, the profitability of the company, why things have gone down so substantially. I just feel like, things haven't been running great, but surely there's got to be some value with this company, right? Think about it. Redwire buys Edge Autonomy for $925 million. The current market cap of the combined companies today, $900 million. So if Edge was fairly valued, that means you're getting the initial Redwire core business for free, for more than free, for negative $25 million. You're getting paid for taking on the core Redwire business pre-Edge at this point. And, they have all sorts of things. They have these cool rollout solar arrays. They're on the International Space Station. They have other contracts for them. They have VLEO satellites, which is kind of like very low Earth orbit. They look pretty cool. They have LEO satellites, like I think it's Mako and Thresher and a few others. They've got satellites for Europe as well as for North America in defense. They've got antennas, satellite structures, avionics, sensors, mechanisms, all this stuff. Like, surely there's got to be some value here if that's getting value, if the whole company is valued basically what they got Edge for. And then even if, say, Edge was only worth $800 million or $700 million and they ended up buying for $900 million, surely that whole core business is worth more than $200 million. I just have to believe that. And then, they have been growing, of course, their revenues. Compound annual growth rate has, I think, been like 35% or something like that, which is decently solid. But of course, the dilution, when you look at this chart, you're not seeing the dilution factor that's fueling a lot of that growth. So that's something you have to worry about. And then when you take a look at the some of the valuation measures, so Redwire now trading at a price to sales of under 2, it's 1.73 versus, say, a Rocket Lab price to sales of 40 at this point. So by that valuation measure, you have to say that Redwire much cheaper than Rocket Lab. So there are some positives around the company, and I do really believe that there's value there at this level, but have a lot of issues and problems with kind of how things have gone this year. Let's kind of wrap up with my final thoughts and what I'm doing with my own shares. So I'm not selling my shares. I'm not happy about how this year's gone. The purchase of Edge, looking back on how things have gone, I can say I'm not thrilled with, and I know it's kind of been pitched as this joint domain command and control with your satellites and your defense and stuff like that. But really, if you're selling satellites to the U.S. Army and drones to the U.S. Army, aren't they just controlling all that themselves? Like, I don't know. To me, at the end of the day, like, it would have been better if they want to make a big acquisition and they're a space company, find another space company that AE doesn't already own. So all that being said, like, I can't sell it here. It's too cheap. It doesn't even make sense to me, even though I do have some issues with how things have gone. I'm not happy with basically any of the numbers the past few quarters and why they've had to keep revising guidance down and all this kind of stuff. That leaves me holding my shares, and the question is, do you buy more at these levels? I mean, it's an option. Like, if you want to double down, I would say you only do it as a value play until the value reaches what you think is fair value, and then you sell, right? So for me, maybe the stock price gets to 14 again, and then I sell my shares at that point, or I buy with a price target in mind, like 14 is a good intrinsic value or something like that, and then I sell. But what I think I've learned over the past 3 quarters or so, or past year, is I'm not too sure if Redwire for me is just a buy and hold indefinitely anymore. Like, some companies I like and I'm just going to buy and never sell if I think they're being run well. I love the business model. I love the vision, all that stuff. And I don't know if Redwire fits that mold for me anymore. The other thing is, with Redwire just being combined with all these different little companies doing different things, I always feel like a company should be worth more than the sum of its parts. Like, you bring these things together and they provide more value than if they were separate. Rocket Lab has a good plan for that. Like, bringing launch together with the satellites provides more value than those two things being separate, because then you can launch and operate your own constellation. You've got margin stacking going, the full end-to-end space company. For Redwire, I'm just starting to feel like the company's value is exactly the sum of its parts and no more. Like, I don't know if there is that much synergies or margin stacking or ways that, owning the solar array business really adds value to the drone business, to the RF antenna business. They got all these cool things in there, and certainly the pharmaceuticals looks exciting and cool, although not a ton of revenue from that yet. But I just feel like, okay, at the end of the day, the value of this company is literally just the sum of its parts. and you're looking for things that come together that provide more value than the sum of its parts. So that's kind of my thoughts today, right now, on Redwire. Not selling. I haven't decided to buy yet just because I'm not happy, but I'll consider it maybe if, because of how crazy low things have gotten. And yeah, maybe look to sell at some point, but it's not just a buy and hold forever for me anymore. So yeah, those are my thoughts on Redwire today. Sorry if it was long and a little rambling. I'd love to hear what your thoughts are on the company. Are you buying at these levels? Are you buying options? Are you doubling down, tripling down? Are you selling? Have you had enough, given up, lost faith in the company? Love to hear down in the comments below. Thank you guys for watching. Please do hit that subscribe button if you haven't already. And I'll see you soon for the next video. Hope you have a great day and a great rest of the week. Bye for now.